So welcome, everybody. Good afternoon. I'm Marjorie Turner. I'm Senior Vice President here at the Urban Institute, and I'm really delighted that you're all as we recognize and learn from the work of Urban's second Janice Natoli Practitioner Fellow, Ricky Granite-Slowitz. Ricky is the CEO and co-founder of Working Credit, and the Natoli Fellowship is a really cool program here at Urban, supported by the Rockefeller Foundation, that lets us partner with and learn from people who are doing the work on the ground and teach us how our evidence can support and advance their work. So this has been another wonderful experience still underway. I want to encourage everybody here in the audience to extend the conversation out beyond the room. So sharing your observations along the way on social media. And if you do that, it would be great if you could use the hashtag #LiveAtUrban. And also include the speakers' Twitter handles, which are in your agendas today. I also am welcoming a virtual audience watching over the webcast live stream. So if you are tuning in on the webcast and you have questions or comments, want to join the conversation when we move to the discussion stage, just submit your questions to events@urban.org anytime along the way, and someone will pass them up to the moderator and they'll get into the conversation. So over the course of Ricky's fellowship here at Urban, she's been working closely with a team here to develop the video and fact sheet that we're releasing today. And we're also continuing to collaborate on additional work that will explore her program's outcomes for participants and really stretch and expand our collective knowledge about how credit matters for both renters and homeowners and how to build it effectively. In the conversation today, we'll be talking both about myths and about facts around credit and credit building. More than a quarter of us have poor credit or even no credit. And for those of us that lack good credit, our options for borrowing when we need to are really limited, and we pay more when we do. So understanding credit and, more importantly, learning how to safely build your credit is really critical, and it can make a dramatic difference to people's financial future and their ability to move themselves ahead financially, potentially out of poverty and into financial security. For those of us working here in Washington, understanding the facts and what to do about them is really critical for policy making. Policies that effectively support credit building can, as I said, help increase mobility from poverty and really help low-income Americans keep more of the money they earn rather than spending it on high fees and unnecessarily high interest rates. So the big goal today is to increase knowledge in the field, increase knowledge among the public and policymakers around the credit building issue, and what in the room and on the webcast, we're bringing together researchers with practitioners, policymakers, advocates, to really dig deeper into both the myths and the facts about credit, why those myths are so persistent, and how credit building can be expanded for low-income Americans. So again, I thank everyone for being here today, and I want to pass the microphone over to Diana Elliott, senior researcher here at Urban, who's been Ricky's lead partner here, and she'll present some facts about the costs of poor credit and credit myths from the fact sheet being released.
Great. Thank you, Marge. Today's event, as Marge said, is timed with the release of a new fact sheet. And we're also going to unveil a video about credit myths as told through person on the street interviews. And I should note as well that the fact sheet will be available at the end of the event, so we encourage you to take that with you. And so when Ricky started as the Napoli Fellow, she highlighted for us that there are a lot of credit myths out there that prevent people from building credit. So if we could just bust those myths and improve the knowledge base, then many, many low-income families could benefit and build credit. And as the slide shows, having a subprime credit score is really costly. 27% of Americans in the credit system have a subprime score, and they pay more to borrow because of it. They would pay nearly $3,000 more in interest than someone with prime credit to purchase a $10,000 used car. Without a credit card, someone with subprime credit would pay nearly 3 times as much as someone with prime credit to purchase a refrigerator at a rent-to-own store rather than using a credit card at an appliance store. And let's suppose a car breaks down. Someone with prime credit can use a credit card, while someone with subprime credit might have to use a payday lender and would pay nearly double the cost of the repair. And if more Americans understood the truth about credit, then maybe they would pay less to borrow and would have better opportunities in the future. So I'm going to go through a few myths now. One of the myths is that you have to be wealthy to have good credit, and that's false. Your income, savings, race, ethnicity, gender, where you live has no causal effect on your credit score. Another myth, if you pay all your bills on time, you'll have a good credit score. It's a little bit of a trick one here, but it's false. Even if you pay your bills on time, which is a really good thing to do, you may not have a credit score. To generate a credit score, you have to have at least one creditor that reports monthly payment information to the credit bureaus, which are typically credit card companies and mainstream lenders. Another myth, everyone has a credit score. False. Nearly 1/5 of U.S. adults have no credit score because of insufficient information. To build credit, you have to go into debt. False. You don't have to go into debt to build credit. You can build and sustain prime credit by opening just one credit card, using it to pay for small expenses every month, and paying it back in full. And this is the equivalent of a 0% interest loan if you pay it back in full. Don't seek out credit. Inquiries can ruin your credit score. False. An inquiry may typically lower your score by a little bit for just 2 to 3 months. And if you rate shop, all inquiries within a 45-day period count as just one inquiry. What really lowers your score is a payment that is 30 or more days late. Having a lot of credit cards is bad for your score. False. See where this is going. The scoring system does not look at how many cards you have, but how you use them. So to have a strong score, pay at least the minimum balance due, pay it on time, and keep the balance on each credit card below 30% of your credit limit at all times. And finally, rent, payday, and auto title loans, if managed well, can help you build a credit score. False. So most rent, payday, and auto title loans are single repayment loans, which are not typically reported to mainstream credit bureaus. Rent payments are not often reported either. So the most ubiquitous payments and products in low-income communities do not help consumers build credit. So let's find out what people on the street have to say about credit.
Credit has been good to me. Credit has been bad to me.
Credit is
They're convenient. They're very dangerous. Some people just keep throwing them out there, and at the end of the month, they're like, "Ooh."
I hate credit cards.
Well, I just started using a credit card a few months ago. I don't like the fact that I owe the bank $500 already, and I don't even have $500 in my pocket.
Do I think my income factors my credit score? Honestly, I'm not sure. I want to say yes, because that's sort of my basic understanding about it.
I do not think my income is calculated into my credit score.
When I look at a credit score, I think where I bank is on there, but I don't believe the amount that's in my savings should be getting pulled into that report.
I think gender gets factored into your credit score.
Absolutely, I think race is a factor in calculating your credit score.
All right, my first credit experience, I guess paying my phone bill, correct? Is that correct?
I have a couple credit cards now, and I do not pay them all off at once, and I was told to not do that.
If I had known that spending only 30% of your available credit line would positively affect your credit score, I would have kept my 500 line below 150 because I was not told that when I opened my credit line at all. I'm a little salty about that.
Off the top of my head, if I wanted to improve my credit, I would try opening more lines of credit. I would keep my payments current. As far as I know, I think that's as much as I would do the two big things.
When a person has poor or no credit, they have limited options for financial products and are charged the highest rates to borrow money. 27% of Americans in the credit system have subprime credit, a credit score below 600, and pay more because of it. To put this into perspective, a subprime borrower would pay nearly $3,000 more in interest to purchase a $10,000 car than someone with prime credit. That's the equivalent of a $1.40 per hour raise. The good news is that there's a solution. Within 6 months, someone who has no credit score whatsoever can have a prime score by using either a safe and affordable credit card or installment loan, and by practicing good money management. There are a lot of misconceptions about credit that stand in the way. By clearing up the myths and presenting the facts, there's an opportunity to improve Americans' access to good credit and to pave a pathway to better financial health.
I absolutely see a future where I could be improving my credit score. As I get better educated, it's probably not nearly as hard or as futile as I think.
Great. And with that, I'm so delighted to introduce our moderator for today, Michelle Singletary, a nationally syndicated personal finance columnist for the Washington Post, who writes The Color of Money, which is an award-winning column carried across among newspapers across the country. She's the author of 3 books, has been a host, financial expert, and contributor to various television and radio programs. She uses her expertise to volunteer at her church and in Maryland prisons to teach financial literacy and wellness. And in addition to all of these accolades, we know from her column that she achieved a perfect credit score. So I can't think of anyone else better to host this panel discussion about credit myths. So with this, I turn it over to Michelle.
Can I talk now? Yep. Yeah. Okay. Hello.
So the elephant in the room, why am I in this chair? Well, okay, I can tell the truth or I can tell you made up stories. So let's go with the made up stories first. I was playing rugby. The one I love the most is that it was a salsa dip gone wrong. But the truth of the matter is I was walking down the stairs in my home and missed a step and fractured my ankle in 2 places. So I'm going to be in this contraption for a little longer. But you know what? The thing about this, what happened to me, is it really woke me up to how difficult it is to operate in a world where people walk. You know? And isn't it the same with credit? Right? I mean, I'm finding that, for example, I thought I was pretty, I swim and, been trying to lose some weight and I realized I have no upper body strength. I mean, my goodness. And isn't that the same with people who pay their bills, on time, pay their rent on time, and yet they don't have a credit score, right? And now that I'm in a wheelchair, I see how the system is not designed for you to be not in the system. Even coming into this building, someone thought cobblestones was really cute. It is not cute when you're trying to roll a wheelchair. And they have the bathroom doors big enough, but you can't get through it in a way that doesn't require some help.
Right.
And so I just thought, moderating this panel, I have a different perspective. Yeah, I have an 850 credit score because everything worked for me. But what happens when you don't? And so with that, I'm going to introduce our panel, and I'm so honored to be among such great people. So first we have Tren Nguyen, who's Director of Workplace Development for the City of Boston. Here we are. She's just cute as I can do. And then we have Bob, I'm going to make this right, Anibale.
Wow.
Ooh, isn't that cute? Global Director of City Community Development and Inclusive Finance. And then we have Ricky Lowitz, yes. Got it, CEO and co-founder of Working Credit and a fellow here at the Urban Institute. And it's just a good looking panel too, I'm just saying. And let's see, we have Brenda Palms-Barber, who's Executive Director of the North Lawndale Employment Network. And then of course you've met adorable Diana Elliott. I love that video, right? Wasn't that an amazing video? Who's a senior research associate here at the Urban Institute. So let me start with you, Diane, since you just showed this wonderful video. And I'm going to ask each of the panelists to just quickly talk about what they saw in the video and their reaction to it. So when you were doing this, were you surprised at how little people knew?
I think we really were. So as background, Ricky was there, Adeze Okoli, who was in the audience, was there too. We were intercepting people all over downtown Silver Spring, trying to get them to participate and get their reactions. And it was amazing, across demographics, across age, there's misconceptions, and you can't pinpoint who's going to have which misconception. And I can attest that when we all heard Ricky first present here at Urban, we all immediately went home and we were like, we have some changes to make. We have some things to do. Because even amongst the researchers here who are really tuned into this, we realized that there were things that we didn't know either.
So what's your credit score?
It's not as high as yours, Michelle.
Used to be your sign, now it's like, what's your credit score, right?
Right. I know, right?
And I have to tell you all, my husband's is not as high as mine. I'm just so I hold that over him. Brenda, what did you see?
I loved it. I thought it was a wonderful, simple, honest slice of who we serve in our community, and the slight embarrassment, the little nervousness that people expressed is what we see as practitioners all the time. And I thought it was, can I take this back with me? How do we use this?
It's on YouTube.
It's on YouTube?
Yeah.
Perfect.
Yeah, we definitely need to have people watch it.
Perfect.
That's great. And you were doing the interviews, so what did you think, Ricky?
Well, I thought it was amazing that we kept on saying to people, how do you feel about your credit score, or how do you feel about credit? And they always answered about how they feel about credit cards, right? People really couldn't make the distinction between tension about carrying debt on their credit cards and the value of a credit score. So it just seems like it just came out that those two are really conflated.
Yeah.
And then people were just so interesting saying, well, I wish, like that guy who said, He said, "You're kidding." So I should have stayed at 30% of the credit limit. I could have done that.
Yeah, I loved his when he said, "I'm a little salty about
about
that."
that.
I love that.
Yeah, there was a lot of that.
I say that all the time. So Bob, you're in the business. So did it surprise you about what they were saying?
Not really, because I think if those were bankers, most would have the same answers. I mean, very few people really look at the algorithms of what's in the scoring model. I mean, I didn't. I mean, I had lived abroad for a long time and came back to the States to rent an apartment in New York for an assignment. And everybody's like asking your credit score. Now, 20 years ago, nobody asked about your credit score. I mean, I don't even remember much about credit scores before I left the States for the Middle East and Africa, London. But then I was renting an apartment, and right there in the management office, and she looked at me like a banker, and you'll be a good tenant. She said, "What's your social security number?" And I had to write it down because I had not used it, except for my taxes in the last 20 years. And there she ran my credit score, and she said, "Oh, it's a thin file." I thought I worked for a bank all these years. But it's a thin file. She said, "Well, there's not much data on you." And I realized and I really hadn't been actively borrowing and using credit. And so my income didn't really matter, or the wealth you might have, or your job or your position. The model didn't have enough data to come up with, an 850.
Right.
And so I think I became aware of how little many of us realized. And that even today, it's only as I listen when people say, well, they're running your credit score when you take out a mobile phone contract. They ask for your social security number because they're giving you credit. Or some companies when you're applying for a job. And somehow that's seen as a character reference. So I think it's important.
Just because you're the banker, but I'm going to just tell you something. They actually don't do your credit score for job applications. They do look at your credit file, but not your credit score. See?
Oh.
See? Aren't you?
There you go.
There you go. Trent, what do you think?
So when I saw it, I was like, oh, okay, I'm a worker, so this is my job. But then I said, oh my God, I'm just like that. So I was jotting down notes about, oh, you better call that bill and see if it's right and check on your credit score, because it ain't about who you serve anymore, it's about you now. So it really made me think, no matter how educated you are or what you think, that this country and where we live now, we have to always watch out for ourselves and for each other as well. So it really brought me to myself, but it brought me to the work that's really important. And I just want to say that as humorous or as important as the issue, we see individuals reflected on this. This is kind of like a macro, huge problem in this country. For instance, in Boston, when we worked with the Boston Feds on a report called The Color of Wealth, we found that in liquid assets, not including cash, The Color of Wealth, which is online, revealed that for every dollar of savings that white households of U.S. black households only had an average of 2 cents, Caribbean black households only had an average of 14 cents, and Puerto Ricans and Dominicans household had an average of less than 1 cent. This is the U.S. of America today in 2018. We then looked at every 2 years, we checked Boston to make sure of the financial security and health of our residents and community, and found consistently that in the last 2 years, 42 to 46% of Boston residents are liquid asset poor, meaning if something happened, your car breaks, you had a dental plan, your foot, you have to make sure that you're going to the emergency room, your medications, all of that would lead you in liquid asset poor, and then you will then have a bad credit score. So when we think about credit score, we think about the numbers, but we don't think about that huge impact, how it impacts your livelihood, your job, your mortgage, how you live, and how you raise your families. That's really urgent in this country.
So I'm going to go down and talk to each of the panel about the credit myths and why it's so important to build people's credit. So, but since you were on the data points, talk to me about the control study that you all did and the results that you found, and then the follow-up. And can you do all that in 2 minutes?
I will try my best, but a lot of this is online. And so what we wanted to do was do something cost efficient as a policy. You know, we all think that government works. We have to have a new program. It's going to cost millions of dollars. So we are really challenged with doing something cost efficient, an integrated approach and model. And so what we did was we designed what we called a financial checkup, short 20-minute checkup that provides credit history for residents, financial education, counseling, voter registration drives, and all the social and supportive services all in one checklist. We then integrated in some of our larger programs, such as the Boston Tax Help, and also in the future the Home Buyers Club. And
when you say integrated, what do you mean?
Meaning this financial checkup called the FCU be integrated in current home buying classes, larger citywide programs such as the Boston Tax Help, and so infiltrating that citywide, and employers such as the City of Boston, hospitals, and local employers in the city. And we found that, for example, we did a randomized control study because we always want to do everything, but we don't know if it worked. We found that this short 20-minute checkup integrated into citywide programs, we found that on average, the clients we worked with had credit scores improved by 15 points within a year after receiving this FCU, relative to the comparison group that does not receive it. So this, for example, which we didn't see, but now we do, we translated this into large savings on interest payments. For example, $600 in interest savings on a 4-year, and then a $10,000 used loan. $600 is a lot. And then also think about that into all the savings in your mortgages, your car loans, your student loans. So we don't think about those savings, and we really should. So that's one of the examples.
So fast forward, and then I'm going to move over to you, Bob. So fast forward. So now you've integrated, you've done the checkup. But now what you're finding is that how do you get to the people to get the changes? And my understanding is that you're using employers and places where they go. Because oftentimes we design these programs and we have people come in, and then what happens, they forget about it. And so you've found a way to make sure that it sticks by going to where they are. So tell us real briefly about that.
So this work has been around, we've been doing this work with our partners and research for 4.5 years. And so we said, look, we have scattered strategies, pilots, and evaluations, and everybody's doing everything. So what we did was created an umbrella citywide initiative called Boston Builds Credit, which works to improve 25,000 Boston residents by 2025 to get them to a credit score of 660. We wanted to make sure there's no fooling around, no drama, no all this other stuff about money and everything. Everybody needs to be on the same page about that goal. And so we're working towards that goal. And why we chose 660 was that was a threshold in which folks can get competitive rate loans, and that was an important threshold. But it's very quantitative.
That's good. That's good. We'll come back to you for some more data. So Bob, you tell me why was Citi coming into this space? And you for 10 years you've been working on credit building. Why? You're a banker. What do you care about these small people here?
Well, we're a banker. We live in the same community.
You do?
We do.
Really?
And our employees do, and our clients do. And we're one of the bigger issuers of credit cards and mortgages in the country. And we started very early off with groups like Ricky and Hearst. We were probably your first funder. We launched the Financial Empowerment Center in Boston and the program that you just mentioned with City Community Development, because we actually believed it was about more than financial education. For a very long time, many of us funded and supported and looked at generically financial education. It's a good thing, right? I mean, it doesn't hurt. But it wasn't reaching people. We couldn't deliver something tangible. And I think what we wanted to do, was actually to run some pilots and see who are the best at helping to practically help people improve their score. I mean, Justine Peterson in St. Louis aren't here today, but they're a great group too. And we learned, we spent some time with Aspen We did some pilots here. And, you know, the reports that we did with them, and the title was, again, asset building through the credit pilot. So you're really building an asset when you have good credit, because it gives you the ability to access much more choice, how you get a mortgage or a car, how you get a cell phone account, than you would with a poor score. So we went about building this out. And to us, it was about how do you get people to the right number? And I'll tell you, accessing the right coaching and tools made all the difference. A secure credit card, and that's when you put $500 down, you get a credit limit on your credit card for $500, and they report it, just as any other credit card. That can spike a score. We did a study with Aspen, 71% of the participants improved their credit score.
And by how much would you say? They went from what to what?
It went by numbers. I mean, it was about, let's just say, the score was it got them up to 677.
That's good.
I mean, you went up, and depended who did what. But we've learned also, I think it does matter sometimes. If you were to take, for example, you know it, and Justin Peterson, there are organizations that work so closely to rebuild your score, they may lend you the $500 for the credit card, the secure credit card. Now, that's a nonprofit that's really providing coaching. They're going to report it as an installment loan to the credit bureau. And that, because the Credit Builders Alliance we all work with, right? That can really spike your score. It seems an installment loan that helps a lot. Now you have a secure credit card, and you're going to pay it, and you only use 30% for the 12 months. Now you have 2 clean lines of credit, fresh lines going in. We really saw significant improvements. And so you know what happens? I do think wealth and race, in many cases, and immigrant status matter. Not in the algorithm, but to this access to information. Like it, you know, the wealthier you are, the more you have a financial planner, right? You have a good accountant. You have access to information.
But we live in a country where people say things like, well, you know, they're not managing credit well. Why should I care about that? Why should we care whether or not their credit is built up?
I think, look, even if you were just a retailer, wouldn't you wish more people could have a proper credit card and shop in your store? If you were a car dealer and a distributor, wouldn't it be better that they didn't have to go for a predatory loan? If you're a landlord, you'd hope people could keep themselves and their rent current. Why don't we just share the tools? And we could strip out of an algorithm and a model all kinds of race and income and wealth. But if we don't share the information in a coaching way, the same way your financial planner sits with you and talks about retirement, or your accountant, then we are leaving people behind. And it's just not in our interest to have this. It's just not a part of an inclusive, growing economy to have and these are not small numbers.
Yeah.
And immigrants particularly have terrible numbers and time, as we heard, not because they've had any bad experience, it's because nobody helped them to begin the experience. I often say getting a financial identity, it's like you have to do it as you get a national identity. As you become a citizen, and we work with a lot of mayors on citizenship, you need to also help people get their financial identity. Because in this country, one goes with the other.
Right, right. That's good, that's good. Who knew banker could be so passionate? You don't look like you would be that passionate, Bob. So Ricky, in talking to you, one of the things that you found in your research, and this is what you said, how could there be so many good money managers in low-income communities with poor or no credit? Because a lot of people think that they aren't good money managers. This is why they don't have a good credit score. So how could that be?
Well, you're reflecting on something that we found as early as like 2004, that we were meeting people who paid all their bills on time and didn't have to borrow from friends or family or payday lenders. But then they went to get to buy a new car, and they found out they had no credit score at all. And if you have no credit score, you're going to be treated as if you have a subprime score. So we started to see, here are all these people who are managing their money really well, and yet they have no score. And it turned out, as you are finding out like we did, if you don't have a credit card, or you don't have at least one loan that reports to the credit bureaus, you're just not going to generate a score. And what's so frustrating is if they just knew that, they would address it. But you should know that a lot of the best money managers hate the thought of a credit card and take a lot of pride in not using credit cards, and they hate the thought of having debt. And so because credit and debt are so conflated, the road to getting credit to them says, oh, I have to take on debt. And what we realized is that we could help that same population establish credit without going into debt. And if you just provided the information and, as Bob said, also a product, it helps. To give them a chance to build credit, they could do so pretty quickly. So Brenda runs the North Lawndale Employment Network, and your site was one of the first to test this idea, but you were working with formerly incarcerated men and coming out of the prison system and needing to, trying to get established. Right. And we tested this idea. Could someone go from no score to a prime score in 6 months? And I remember your staff member Pauline Sylvain calling and saying, Ricky, I cannot believe it. Put this guy in a credit builder loan. It's one of those loans that you take $300, but you don't take the proceeds. The money sits there, and as you pay it back, you're building credit. You're showing the credit bureaus that you're responsible borrower. In 6 months, she called me up and she said, you will not believe it, he has a 699.
So let's talk to Brenda about that. Are you trying to take my job? That was, you want to move nicely. And I love what you said, because we in a country talk, I hate debt, I do. If debt was a person, I'd slap it. So
I love that.
I hate it with a passion, but I know that in order to have good credit, I have to have debt. But it doesn't mean that you have to carry debt. I think that's the message. We have to establish it, then put it in a drawer and get rid of it and never have to use it again. You can go back to using cash. But Brenda, tell us about Jovan. Sure. And in telling us this story, you can talk about what you guys have been doing at your organization, which is just phenomenal.
Thank you. So I'm happy to share Jovan's story, and the good news is he's not the only one. But Jovan is a young man who grew up in North Lawndale on the west side of Chicago with a number of brothers and sisters and a mother, where the average income is less than $24,000 a year. And he grew up with a passion for working with cars until he got caught up in the gray economy and wanted to make money and started selling drugs like everybody else that he knew, which led him to cycle a number of times in and out of prison, at least 8 times that he's shared with me, or has done 8 bits for those who work in the system. And he got sick and tired of that cycle and wanted to do something very different. So he learned about our program, and we attract you because most folks in our community, where the unemployment rate is 23.4%, are looking for jobs. And 57% of the adults in our community have had some involvement with the criminal justice system. And so we have programs that are specifically designed to meet those who are returning citizens and our financial education supports. So he entered our program with the intent of looking for work. Yeah. And then we got him on a track around finances. And what we learned is that he didn't, like many folks, didn't have a great relationship with credit, with money management. We actually helped him to file for bankruptcy, to start a new fresh start. And so fast forward, the beautiful thing about Jovan is that, so he's married, he has a beautiful wife, he has 6 kids. Unfortunately, one of his son, who's like 13, was shot, was hospitalized, but that didn't stop Jovan from maintaining the job that we helped him to secure. He maintained his financial coaching sessions with our staff and eventually began to use some of the products, the secured credit card that he did, built his credit, that then led to him saving more money. And as soon as he could, he bought his wife, for the very first time, a new used car. And he couldn't wait to tell me. He comes into my office, he says, I bought my wife a car. It's just one of those days. And this is about 18 months, but it gets better. So after he's gotten into the habit of saving and building his credit and working a job that we help place him in with CTA, he has qualified for a home loan through JP Morgan Chase. saved enough money. Sorry, city.
We fund her program.
Yes, you do. You do.
And it's not self-serving.
That's right. But he just qualified for a home.
Wow.
Saved enough money to do that and had the credit that allowed him to change the trajectory of his family and generations to come.
Yeah.
So that's Jovan's story.
What I love about that story is that it started with a program about workplace placement,
Yes.
right?
Yes.
And what lots of folks who run these programs don't understand that those two things, finances and workplace, go hand in hand. How did you all figure that out?
Well, that's a big part of how Ricky and I met. In 2004, we were in partnership also with the Annie E. Casey Foundation that was doing work around Centers for Working Families. And we signed up and understood very quickly that we were putting a lot of folks in entry-level jobs, right? And so I thought, well, how are we helping folks manage that money? We all have heard the terminology of, paid on Friday and broke on Monday. And so we thought, how can we better help folks retain and understand how to make that money stretch to the end of the month? And so today, financial education and coaching and credit building it's embedded. It is in the DNA of all of our workforce development programs. We fundamentally don't think you can offer a good workforce development program without financial education.
That's good. That's really key. I'm going to get back to some of the results you have, but you, Ms. Thing, talk about. Let's see. I had a question about the survey. So, who benefits when we get residents to be financially healthy credit-wise?
Yeah,
right.
Everyone. Everyone benefits. We've done some work here at Urban that looks at the city impacts of financial insecurity. And so we did a pretty detailed brief on Detroit, for example, found that 2/3 of Detroit residents have subprime credit. 2/3 have delinquencies. And when you think about how big Detroit is and how that spreads across most neighborhoods in Detroit, there's only one neighborhood in Detroit, one zip code, where they didn't have subprime credit.
And what neighborhood was that? Like, we don't know.
It was downtown, and it tended to have better educated and more white residents in it. So, and again, that's just a correlation, not a causation, right?
Right.
But if you think about
Now explain that when you say that.
Yeah.
Because I've been to grad school, I know what you mean, but just why is it important to say that? Because if we don't change the conversation that these poor and Black and Hispanic folks are not handling their money well and they're trifling, you all know that word, trifling? All the Black people are shaking their head, yes. It means that you don't do things the right way when you sort of know you're supposed to, but that's not necessarily the case, right? So why is that important to say?
It's important for all of the reasons we showed in that film, because these are myths that need to be busted. And once people have this knowledge, they can become a Jovan, and that is a beautiful thing. We could have Jovans all over Detroit, improving their financial health and purchasing homes in Detroit.
Yes.
And go ahead, Bob.
I just want to say, because we're working with Vicky in Chicago, and we've worked in Boston. Employers are really important aggregators, and you've already got somebody, or you get them into the workplace. We need to get this effectively out to larger numbers, because once somebody knows it at home, a lot of those other families that did come from middle-class white families, and you do the correlation or you do the causation, had information from somebody else. It wasn't magic, it's just that you knew someone, right? I mean, I have a doctor in the family. He only does one thing, but everybody asks him about everything. Right. We have a navigator. Poor guy is stuck with us. But, I think it's the same. So employers, and it's important, public employers, we have a lot of low-paid people working in public services, healthcare workers, the hospitality industry, and that's why in a wealthy city like Boston, one of the wealthiest cities in the country, iconically, it's small, but it's got probably the most unaffordable housing, along with San Francisco now.
Thanks, Bob. You live in New York City, by the way. You're talking about Boston.
But that's a really good point. And Trent, that's what you guys have found. And what I think employers do a disservice is they have benefit programs, but they don't have a strong financial component in those benefit programs. And that's what you were saying, that when you were using the term aggregate, that let's go to those workplaces. So tell us a little bit about that. That's been one of the passions that you've had with Boston Building Credit, right?
Yes, we were very clear that this was not a siloed mega program. That it was an integrated strategy. So it wasn't going to be in an office somewhere in City Hall, that it needed to be in the ecosystem of the cities. For example, these employers, we know that they're low-wage workers, lots of Boston low-wage workers. In fact, you know, the numbers are skewed. The majority of women and people of color in Boston happens to hold lower-wage jobs. We knew that we couldn't go to scale and just do one by one, but we had to go to large employers. And we're doing it with the city that's being piloted, and then we're trying to infiltrate that with the hospitals. We also looked at our home buying classes. See, we were already serving 3,000 or 4,000 people, you know, every quarter. Why not integrate a marginal cost effective tool into an already existing scale-wide programs? Our Boston tax credit that works with earned income tax credit eligible households in Boston, they're already working, and we were serving 12,000 Boston residents in the city anyway. Why not go to those programs and infiltrate this financial checkup tool that we had to build the credit? So all of this was a marginal investments, didn't cost a lot. It was a lot to train and change the culture that credit building is really important, but then infiltrating it into scale-wide existing systems in the city.
So have you found any results so far? I know you've got the 2025 goal, but at this point in your experiment, what kind of results are you seeing?
So we're seeing currently we are about 3,000 to 3,500 a year, and we're looking and we're trying to track new residents and those who are already been tapped. And so we're really strategizing on those who are already serving and following up, and then also the new clients. So we're averaging about 3,000 to 3,500 from various nonprofits in our Boston Builds credits. But we know that's not enough to just tap in on nonprofits. We got to go where the scale and the numbers are. And so we're trying to pilot, we're piloting, and we're not going to get the results from the city of Boston and our larger employers until probably 12 to 14 more months. And I'll tell you, change is ridiculously slower than we anticipate, but working together is really important because we're not creating a program, it's an integrated program. That means your lead partnership and your anchor means a lot to us. We lead from behind. You have to be the lead. And so I think that work and that culture shift is a little bit harder for the government agencies that have been working in silos. So it's going to take a little bit, and it's slower than we anticipate, but it has been very impactful. Ricky has a lot of experience with that too.
Well, I was going to say, we actually work in Boston with one of our employers is Boston Medical Center, and they've welcomed us in, and to Bob's point, you know, having done this work in a job placement context or social service context, it was actually, you know, our thought that we could go to scale if we could do this in workplaces and do it with employers. And it actually has been very interesting because HR, like, you know, what makes an HR person really good is, you know, can they provide the benefits that people really need?
Right.
And is there take up? And then often if you hit a very low income population with a retirement benefit, they're like, that's not going to help me right now. And HR knows that, not only because they might not be taking advantage of it, but if they had a 401k, they may be borrowing against it.
Right.
Right? And they hear about things like garnishments from payday lenders. And they see people not being able to save for retirement. They're not participating in the normal suite. And we brought in credit building, and the reason why I think employers want it is because someone with bad credit on their way to work, and let's just say they're a home health aide and they're going to go work with someone with dementia, and the car breaks down.
That's right.
And they don't have a credit card to respond quickly. And so they don't get to work. Now, this is an excellent, you know, employee who wants to do a good job, but if you don't have a credit card, you might end up having to get a friend or family member come get you, or you might end up going to a payday lender. And so the employer...
Or losing your job.
Or losing your job. And if you lose your job, you lose your home. And it all starts out with, I didn't have money to repair my car.
Right.
And it was like $300. And we, you know, so many things start with $200 or $300 problems. But the employer feels that, and it reflects poorly on the employee, even though they know they're excellent. But the person who isn't reliable, you can't give the good jobs. You can't keep them with you. And that's why I think healthcare employers are kind of taking the lead in this field, because it's kind of a life or death thing. But I think other employers are following suit.
But you work with a lot of, go ahead, Bob.
We're just saying, we're working with Ricky on a very big project in Chicago, Cook County, and it's going to be anchored in healthcare.
Yeah.
I mean, it's going to be anchored in a large healthcare employer, because we think the same, that if we could get these, you know, very deliberate, very focused, and the employer is going to play in the game with us, we can really hit a large number of people who can then advise other people. Right? It's that contagion.
But Brenda, talk about that, because is it that easy to get employers to do this part? I mean, you guys work with great programs that do, but my experience is they just want to sort of hit them. They don't want to be bothered, you know?
Well, it's very hard.
Did you say Ricky or Brenda?
Brenda, you.
Okay. Well, they don't. I mean, to be honest, I mean, the challenge is sometimes they don't want to work with folks that have a record, right?
Yeah.
So we have to show value and the benefit, and of course the return on investment for them. But then I think what excites me about working with Ricky, because we're excited about working with her, is introducing her services to our employers, because we see it as a retention strategy. So you have to approach it in a language that speaks to that employer. So how do you reduce, you know, the cost of turnover by shoring up through these financial supports? That's really key.
That's really good.
And so that's one of the ways that we plan to address this. And I'll just add that even though they're not necessarily our focus, I have come to the realization that our staff of nonprofit organizations, the people who are working with and delivering these services to our clients, are often the same people.
Yep.
And so one of the decisions that we've made is to actually contract with Ricky, and you didn't know this, but it's been in talks, so that you can come in.
She got a job, right?
Well, so that she can bring those kinds of credit building services, because 90% of the people I work with, or that are my employees, are people of color who have middle wage jobs that are struggling, and whose credit scores they don't want to reveal. But I have come to a general conclusion that when folks' cars break down, or there's a healthcare matter, that can really challenge their retention on the job. So we have to bring it to the workforce as well.
Right. Go ahead.
I just want to say, employers, I think for a while we had to learn how to talk to
their
them.
language.
But I have to say, now that if we hit an HR person with a large population of relatively low-skilled workers, and we start talking about this stuff, they actually, sometimes they're like, we need your benefit and we need it tomorrow. And the reason is, like, the retirement benefit is going to pay off in like 30 years, but the person needs help now. And so I have found that we had to learn how to work with them, but they're incredibly receptive because it helps them too.
Yeah. We need the data to get them to do it.
Yep.
We need the data, and then they have to pay for it.
Right. Yeah. Why is it so important? Just for her, just a second, I want to get back to you, but why is the data so important? Why is what you did in looking at that so important? Because we know, those of us know this, we know that it's there, but why is it so important to do the research?
Well, and at Urban, we're all about evidence for policymaking, for smart policymaking, right? But if you don't have the evidence, it's really hard to make that case, right? So when Ricky walks in to talk to an employer, to have that evidence and to say, this is what we know, this is what we can do, that is powerful.
Right. And what I loved about that video is, if you all noticed, that it was white, it was black, it was young, it was old, and I think that's the myth that we have to bust as well, that it's not, and those of us of color will hear, even those of us color say, well, black folks, we get our hair done, and, but that's not true either. We all bad, all of y'all are bad with y'all money. If we poll y'all credit scores in this audience and looking, you'd be like, right. And that's important too, right? Because if you're looking across your employment base, you're thinking, well, that's just them over there, right? And that's why the research in that video, I think, is so important, right, Bob? Because you so don't look like me, but you were really there,
Probably
right?
have a better degree than me. I don't know. But getting employers, it's true. we're trying Boston and Chicago, but it is about showing the evidence and saying that this benefits your employees for all the I love you're right, use the right language. And then they need to say that there's a cost to, you're bringing some coaching to your employees. But what does it help in retention and motivation and every other way? I think it's a great tool, and we need to deliver products and services with it, so it's real for the individual.
Yeah, I cut you off, but what were you going to say,
No,
Jen?
I was just going to say that working with employers within workforce development training programs is a challenge, and so adding credit building
So why
is
is
also
it a challenge?
another.
Why is it a challenge?
Because they're already negotiating priorities with hiring from our graduates. So that and hiring preferences and first source agreements, employment agreements with development projects going on in the city of Boston. So another layer or another hurdle that they think that they have to oblige to might be a challenge. But that's why it's important for the city of Boston to be a lead example. I mean, we can't go out there and preach and say, why don't we get all these employers to hit our numbers for the Boston Builds credit? Why doesn't the city of Boston be that leader first? And because we are one of the largest employers, and we have low wage workers, although they're really good jobs that pays well, and they're stable jobs. So why not go to a constituent, a large group of constituent, and tackle it there? And then we can come out and say, hey, you know what? We want everybody to do it because we're putting our stake in the game too. So it's important to be accountable and to be a partner and a resource in that landscape.
That's great. Let me ask you guys a question. So there are people here in the audience and hopefully watching online, or hopefully will watch later. They're saying, I'm bought into this. You're so right. Now what? Do they contact you? Do they look for similar programs in their community? I know lots of nonprofits or consumer credit counseling agencies are doing those sort of credit building loans. You can do so much, and I'm sure you want more business, but where should people go from now if they're listening? Like I'm personally and then corporately. We'll start with you, Ricky.
Well, I could say, one of the things about credit building, and Bob and I have talked about this for a long time, it's a little bit, it's tricky on the ground, and here's why. A lot of people do hate credit, right? So we just turned it into a service program because we had to say to people, are you willing to say to someone who might present with $2,000 in collections, right? So this is what happened in my when I started working on credit. I had a bunch of counselors who were doing this work. They would meet someone, no score, and about $2,000 in collections. And the advice at the time was, you can imagine, pay back your collections.
Right.
So if they paid back their collections, kill themselves for 2 years, guess what their score will be?
Still bad.
They'll still have no score.
Yeah.
Right.
Because they have nothing to generate a score. And so, but yet it's almost, especially if you were a housing counselor, sometimes they're like, you got to pay back those collections. The banks and others will say I can't see you beyond those collections. The truth is that they have a better chance of paying back the collections if you can get them a product that will then,
That's right.
establish a score, and then you go from a 25% car loan to a 5% car
I
loan.
see.
But that is a big leap, especially depending on your background. It's not just that you're scared of credit, your mother's scared of credit, your grandmother.
Big mama.
Right. And
Yes.
I had actually people who worked for us who said, I really want to do this. I can't. It just feels so risky. So I will say we started Working Credit, our group as an employee benefit, as a national organization, so that at least for the employer side, there's so much opportunity elsewhere, for community, for college students and for other. We don't do that work, and Brenda's work with job placement programs and other types of social services. But we thought, let's be able to go anywhere they want us and offer this benefit with people who are not conflicted.
But answer that question, because that is a huge leap. I hate credit. I've said that, and I probably never, no credit card company will ever hire me because I hate credit. But I have credit, and I understand how to use it. But it is hard because they're scared of misusing it, just not out of malice, but that something happens and they go too deeply in there. So how do you walk that balance? I mean, you represent the devil. credit companies. No, I'm just kidding. No, but I mean, really, you represent the industry that is selling credit, which we've been told is bad, and it is bad for a lot of people when they misuse it. So how do you do what you do?
You could say the same of pharmaceuticals or many others, right?
Yeah.
You need advice, how to use things with judgment and well, right? These are tools for you, and I think that it's exactly that. Then when your car does break down, you don't have to have a predatory loan in order to get on the road. You can bridge it, and you can pay it back, as you're flexibly.
Right.
It's the most flexible tool, but it takes control, right? It takes managing. And I think it is about getting information. I really think information is what people, some people have it just because of who they knew, or where they were, or their parents. Ricky, of course, I always have to say, I was in St. Louis. Justine Peterson is the name of the organization. They're great coaches on this, and they were the example to me, to somebody in their group. Don't pay the 3-year-old doctor's bill, because the model weighs much more contemporary reporting on your credit. Now, it doesn't mean you're not going to resolve that, but as you have to make financial decisions, as we all make choices, having that information helps you to make it. And I think you just have to, we all should have information.
But Brenda, can you speak to that? Because there is, you can get the information, but there is a fear that you will overuse it. One of the reasons people don't do it is because they don't trust themselves.
That's
so maybe
right.
you could speak to that,
Right,
because
that's exactly right. And I think that in talking with my staff and talking with my financial coaches in particular, one of the things that they reminded me of is, listen, most of our clients didn't sit down at the dinner table and talk with their parents who said, here's how to save money. Or we just didn't talk about money, right? So they didn't have that dinner conversation for the most part. So it's almost akin very much to workforce development. If you don't understand work ethic, if you haven't lived it and seen it in your own home. And so I think that's why our financial coaches are key. As you're saying, Bob, someone to walk them through and help tell their own stories. And I said, well, how do you guys establish trust? Because talking about your finances for me is like talking about my weight. I'm not gonna talk to you about it unless I really need to talk to my doctor, right?
Right.
And so what's happened is they open up and they share their own challenges, their own stories, and a trust begins. And then we give them bits and pieces that over time keeps them coming back so that we can show progress. And so it requires, it's not going to happen, that fear and mistrust that you talk about doesn't happen without someone to help guide them and to coach them.
So you're talking about relationship building, which is what you
It's
do
key.
with the organizations, right? And you help their folks understand. So really what we're all talking about is that it's not going to take, and I think that's what you're saying, Trent, it's not going to take what we used to do with credit is have one workshop, this kind, here's what this is. That's not going to work, right?
Long-term relationships.
And I was going to add one point that the data kind of bears this out. So if you think about it, in every walk of life, as you would say, there are good money managers and bad money managers. It's just that if you're if you live in a low-income neighborhood, chances are you may not be, you might be an excellent money manager and you'll have no credit. Right? So what we're kind of finding is that population, they're good money managers, they just didn't have the information. It's really quick. So we see in our data that within 6 months, we see kind of, over the life of our product, we see a 41% increase in the number of people we work with who have prime scores. But most of the movement is in 6 months. And a 39% increase in people who are walking around with at least $1,000 of credit. And actually, what it means is that they can kind of, for the first time, buffer, have a buffer towards or something.
It's like insurance,
Right.
it is a buffer that we have. Middle class people have it. And it's just a matter that, and the insurance might have a deductible, right? I mean, I live in the UK, so we have national health. I don't have to think about this. But you have a deductible. And that's the other thing. And so maybe that did have to go on the credit card, the $300. And while you then sort out the insurance and you deal with it. And I think it's about, we have to also train the trainers. A lot of financial coaches are pretty low income themselves, very mission driven. Some come from social services background and other areas that they're primarily focused. Their own financial lives are difficult.
That was my point.
I also think we need to train policymakers too, right? Because I think there's this myth that we see, right, where we focus a lot on savings, and that's great that we've been focusing so much on savings in the asset building space. But there's also this need to think about credit as a complement, and that's something that has really been missing from a lot of the conversations.
That's true, that's good. And also just, I mean, what you do, just, there's a fear of the bankers, and they aren't in the communities. Like traditionally when you go into these communities, who do you see? It's not Citi, it's not, you know, JP Morgan, it's payday lenders. They're going to the people, and that's the first thing they see. So when they're trapped, I would hopefully encourage the institutions to go where the people are, and they can make money off of them without being predatory.
So you're right. I was going to add that, I was going to add, you really have hit on a point that we feel strongly about. You know, we talk a lot about food deserts, but we think we have a banking desert.
Yes.
There is one bank in North Lawndale that serves a community of nearly 40,000 people. And I can tell you for sure that we have at least 10 check cashing businesses in North Lawndale.
Yeah. And I'm going to say it, I don't represent Urban Institute, this is Michelle Singletary, but payday lenders are sharks. And it's a horrible business model for the most part for most people. And I just wish that more bankers like you would appreciate that they need to be in these communities to help these folks.
It does go back to policy, and I'll be quiet because here's the thing. I talked to my team again, and I said, why is it that people are so comfortable going to check cashing places instead of traditional banking? And they're like, well, it's convenient. Number one.
Yes.
The convenience is number one.
That's right.
Number two, folks have issues that get surfaced when you traditionally bank. They don't think they can get a checking account, and we find out that 90% of the time we can get them a checking account. So there are the myths again.
And I think that's why, for us, it's really important to work with partners that have the trust and they're in the community. I mean, all of these programs are with municipalities that we're funding for years now to learn with. They have seen people coming in from many other ways. As you say, not everybody will come in. You can have a bank branch and not find people coming in because they really have. I came in, and you might have. I went in with my parents. I had up my first savings account at a community bank with my parents. And so we're opening accounts for many people. I look at Green America with immigrant women in New York, 10,000, 20,000 women that we have. But they came in through an organization in a neighborhood with dozens of bank branches. They didn't have one because somebody or an organization that's trusted and understands a bit more the complexity of their lives helps them on that journey.
So we've got 5 more minutes before we go to Q&A, both here in the room and then online. If you're online, please send in your questions and they will funnel it to me. But just as a wrap up, we've got 5 minutes. This is such an important issue. So if you each could talk about the why behind why we should care. And we'll start with you, Diane.
Okay. I mean, the why we should care, a lot of the research that we've been doing lately, that I've been doing lately, is looking at wholesale change in cities, how financial security of an individual impacts a whole city, right? So if you have financially insecure residents of a city who have subprime credit, it affects a city's budget. So we think that we're removed from this, right? I have a great credit score. Why do I need to worry about this? Well, you need to worry about it because it affects how much your city budgets are going to support people who need that help.
That's good. That's good. And Brenda, what do you say?
Sure. I mean, the racial wealth gap is real. I mean, I can't help but see that through the lens of a neighborhood like North Lawndale, where I come from. But I think in addition to bridging the racial wealth gap, for me, it's if we can improve the quality of life for folks in general. I can't imagine that crime would be reduced, that we could be better neighbors, that we would have stronger families. And when our communities do better, our country does better.
That's right. That's right. Ooh, girl. You should run for president. Just saying. Ricky.
I would say, like, we can't wait for, like, we're not going to be able to regulate payday lenders, right? So we have to educate people. And what I wanted to add is all that movement that I told you in 6 months, who's driving that? It's people of color and people making less than $15 an hour. Because we can just see that they move quickly. They just needed the information. So someone on my board named Toby Herr is a great researcher. She looked at all this change and she said, Ricky, don't think for a second that you are changing ingrained behavior. Because nothing changes this fast. This is just information.
Right.
But to one other point about that I wanted to say is, like, the predatory lender is also the nicest person, right? They're always going to say yes. But we have the worst day for us. Oh my God, they're so much nicer.
Yeah.
Have you ever, like, been to buy a car and they walk out and they leave you there squirming?
Oh, yeah.
You know, like, payday lenders, like, oh yeah, you know, they're going to make this work. But what I would say is I lost my train of thought. I'll come back to it.
Okay, we'll come back. Bob.
There's of course the moral feeling of you, if that matters to you. This disparity is extreme, and I think it's getting greater. And I think there's a loss of wealth all the time for low-income people.
Yes.
They're always paying more.
Yes.
You know, you're always going to bodega, not to the supermarket. You always have to go to the check cashier because somebody's paying you with a check. Who gets paid with a check anymore, right? Because of the terms of employment, maybe. But I really believe we can help preserve wealth. And that's why sometimes we say credit is an asset builder, because it helps you to have choice on how you spend, when you spend. And I do believe there's a lot of legacy of a racial and certainly for immigrants in terms of information. And the equitable information, the tools of that is a public service that should be there. And it's for all our communities to be that much more vibrant.
Yeah.
It's good for business, it's good for civil society, it's good for government.
That's good. That's a good logo. Credit is good because it gives you choice.
It does.
I remembered my thought.
What's your thought?
I knew it would come.
And then we're going to wrap up.
53, it's a big one. But like the worst day for us, and this happens, is we get someone like a 720, and they go back to the lender in the neighborhood, and they still get a 25% car loan, right? So it's not just getting a score and assuming everything's going to be fine. You really have to be able to say, no, I can do better than that. So that's our job as well, not just to move the score, but to say, don't take that.
Empower them.
Empower
them. That's exactly right. I mean, can you believe someone tried to pull that on me? Me? I almost went to jail, and I would have been in your program.
There's one last thing, and to shop around, to be able to shop around. How many of you go to a travel agent to buy a ticket anymore? Anybody here go to your travel agency? No, because you can go online. First, you have access online, which you probably need a line, and you have a credit card, or at least a debit card. And you can choose. You can shop around. You know, people want to do business with you then.
Right. 30 seconds or less, Trent. Why is this important?
It's important because it's my job as a government worker for the community to care. So we know that products work. We have the research. We have the data. Our job is to make sure it gets through the supply chain and get a mayor and the city and champion behind it. So Mayor Walsh has been very supportive of our project. He put political capital from day one, and he put money and resources, and he direct all of the department heads to make sure this is a priority. So it's our job, because taxpayers fund us, it's our job to care. And it's our job to care because we have to do a good job for our people.
That's good. That's good. We'll give them a round of applause. This is so great. So we're now going to open up for Q&A. So here are the rules for Q&A. They're rules. I'd love you to tell me who you are and if you work for an organization or an agency, and then a question. A question is something that has a question mark at the end of it. I don't want a dissertation. I don't want to know your life story. We have a reception afterwards. I'm sitting down. I can't go anywhere. Love to hear your story. If you do not follow my rules, you will security. Where's security? So those are the rules. Are we all in agreement? Yes? Okay, because I do not want to injure my other foot by kicking you. So we are now going to open it up for questions. Anybody? And we've had such a great panel. Yes, here, right here. And do we have some mics in the room? Right here, right here front. Yeah, right here.
So my name is Haley Brown. I currently work for the Center for Economic and Policy Research, and I previously worked for the Consumer Financial Protection Bureau. So this is a a topic that's very near and dear to me. I noticed that one of you
Oh, is that a question?
Yeah, I'm getting on the question now. So I noticed that one of you commented that we can't regulate payday lenders. I am of the belief that we could, and we were told we couldn't, and if I were making recommendations to policymakers as to one of the ways to deal with this, it would involve some regulations. What can we do going forward to try to improve our regulatory structure so that it's actually responsive to these communities?
I'm the one who misspoke. It's not that we can't regulate them, because Boston compared to Illinois, like Boston versus Chicago, it's a different world. What flies in Chicago does not fly in Boston. So you're absolutely right. I'm just saying that we can't wait for regulation in Chicago. We absolutely need it. We should really look to Boston. They've done great things. But if we wait, just a lot of people will suffer. So yes, I think we absolutely need regulation. I'm just saying, if we can educate people quickly at their jobs, let's do it, and then keep on doing the other stuff.
Yeah, and I think when saying can't, I mean, let's just be real. We know what the administration has been doing to the consumer, to the CFPB. You can do that if you want to, but we know what's been happening. And then I know a lot of those people in there are fighting still, but they have more money to buy, and let's just be real, that's when lobbying is buying the ear of the policymakers in Congress. And so while we're still fighting that battle, this is what we have to do. So I believe we need to be on two rows. We have to be on the ground, but also try to still fight to get them regulated. And there are many states who've done a great job of that. I'm gonna go to a question online, and then I'll come back to you guys in the audience. What can financial institutions, particularly minority-owned, do to help expand access to credit, consumer credit, while also protecting the health of their bank? That might be, I know you're very light-skinned, but maybe you could, Bob. I mean,
I wouldn't get these shading stories, all shades of gray. Look, I work a lot with minority and community banks
I was thinking
and credit unions. We work a lot with credit unions. I think they have. Like community banks, they're deeply in their communities. They're the most focused on that neighborhood. There are things we can do as big institutions with others too. For example, for about 25 credit unions, including here, 30, and community banks, we've allowed their clients to use all of Citibank's ATMs with no surcharge.
Oh, that's good.
Okay, if you're a credit union, like the Lower East Side Credit Union, you had 2 ATMs, well now you have 2,300.
That's really
all
good.
over the United States. Because you're more likely at night to be driving through Manhattan, even if you live in the Bronx.
Right.
And you're working in one part, and we have it here in Washington too. We can open up our platform and share something. And that's been a huge success, and we're learning together.
That's really good.
We're developing a secure card in partnership with small institutions, because producing credit cards and secure credit cards is a lot. It's very complicated, and you need a lot of the machinery. But we can be a partner behind a small institution who wants to offer that to their client.
Can they call you, Bob? What's your number?
Oh goodness, we're building it out. We're working with a handful of really good, talented companies and small institutions. So I think we have to partner.
That's really good. That's really good. So if you're listening, you know where to find Bob to try to get this happening. That's not for another question. Right here.
Yes.
Wait for the mic. Wait for the mic.
Thank you very much. I'm wondering to what degree it matters how low-income workers are paid in the building credit question. So if you have direct deposit, which if you work for the city of Boston, you might have, but if you work for a small, if you're an auto repair mechanic, they may give you a check. So I'm wondering how that would or would not impact.
That's good. Lynn, and who wants to take that?
I mean, I would just say that if you are getting paid, one, it is important, I think credit building is much easier if you're working, because if you're not, you're stressed and you're looking for a job. But it's almost, I would say, to your point, the lower the pay, the more important it is that you're not paying inflated rates, right? If you're having really low wages depleted because you have an expensive car loan. So you kind of need to reach a person. I mean, people who are looking for a job can't necessarily focus on their credit, but as soon as they can. But if they are low wage, oh please, you want to get it to them because they can't afford to have that, the person who's paying $1,900 for a refrigerator, who's making minimum wage when she should have been able to buy it for $600. You need to help that group.
So Brenda, you want to?
I was going to say, the sooner that you can engage them with a institution of moral integrity, right? And I say that intentionally because there are products that can still be predatory and not right for that particular person. But that being said, the quicker we can attach them and connect them to that institution, the quicker we're going to be able to help them begin to build their credit. We get people into the habit of saving $5 a month, literally, and then opening up a secured credit card that we can start to make payments on that help build. We can't get away from the importance of, I like, Bob, that you said you see credit as insurance. It is, because if something happens, I have peace of mind in a way that I didn't have before when I have a credit card, even if it's $250.
Right. Okay, question. I see your hand on the back, right there. Yes, ma'am.
Hi, my name is Christy Arnold, and I'm the executive director for Lift DC, an organization that's a 2-generation financial and career coaching. First, hey, Michelle, you spoke in my church at Alfred Street. Hey.
Right. Oh, yeah.
Yes. But our work does the financial and career coaching with the parents. I'm getting ready to I promise. So with the parents, we do the coaching with the parents, and we partner with.
Let's stop. So I love that you're going to tell that, but what's your question?
My question is about the fact that we partner with ECEs and we work with organizations that serve children. And so I'm wondering if there is any, do you all have any thoughts about teaching financial education and credit to children?
Good.
Because I feel like a lot of the story that you shared is too long.
That's good.
I just want to make sure we talk about the wealth disparity.
Nope. I love it though, girl. I'll be here. Stay by. We can talk. So how do we get to the kids is what her question is.
Well, I can just say, you could talk about this. Like a citywide initiative,
we're doing
you could do all kinds of things.
I would just say, look, we haven't done credit yet. We set up a program with the City of San Francisco, with the Treasurer's Office there, and it's the only universal child savings program in the country. Every child in the City of San Francisco, 5 years old, whatever your status, gets a savings account, and they put $50 or $100 since it started, and there are incentives to save. Now that means everyone in the room, and remember, think back, my generation, before free lunches, where for those who couldn't, some kids ate lunch and others could watch. Now, we wouldn't accept that anymore, hopefully. And it's the same idea. We can't talk about financial unless everybody in the room understands it.
Right.
Everybody got a piggy bank then. So what we got to look at is how do we, working through school systems, and make sure we start sharing information early. In this case, it's about saving. It's called kindergarten to college.
Kindergarten to college.
It's an aspiration. We train you for education. We got to train you to save. Now, you may not have a lot of money when you finish that, but you learn to budget. You learn to put some money aside.
But Brenda, I bet we get to the kids through the
parents.
We
do. We focus, but we actually have a program targeted to teens because they're getting ready to go to college or they're going to be working, and we want to be able to help them. So we partner with local high schools in our community to get to that. But I also know that there is room and space for us to start younger. But I'm not sure if we're the right agency to do it because of what we do. But I think that we certainly could partner with other organizations that do that. And I think I applaud the effort to start generationally because that's where it needs to start.
And maybe you guys can have a conversation once we're done. Did you have something you wanted to add?
No, I was just going to say to Bob's and Brenda's point that the city of Boston also launched the first children's savings account, Boston Saves, and it engages parents first to talk about college and then small savings, even if it's $5 a month. but then really building on financial capability and credit building as the years move on. But those tools really help in cities.
And, you know, I'm a big believer in having financial education in the schools, but really lasting values are taught from the parents. When they do studies and they look at who influences children, it's not their peers, which is what we think, it's their parents. And so if you're going to have a lasting effect on how children learn how to handle credit and save and stay out of debt and so forth, you have to start with the parents, because they're the ones who are going to reinforce it. I know I've got 3 kids, they're all cheap as me, and I just love it. One question we had, yes sir, right here, and then I think that might be the last question. But we will be around. There's a reception if you're online. You know, continue to have the conversation online. You have all of our Twitter handles and Facebook and Instagram. If you send us questions, I know I'm personally happy to answer them as well. And, you know, you read my column and, you know, you'll get to know a lot of this. Yes, sir.
Hi, I'm Steve. I go to school in Boston at Suffolk University. How does the rising student loan debt and the potential of students defaulting going to affect credit?
Ooh, that is such a great question. Really succinct. You follow directions. Love it. Yes, anybody? Diana, you want to?
I think, yeah.
Ricky? I would just say the thing about student loan debt that people really need to focus on is if you don't pay back your car loan, you're going to have a delinquency and your score could go down 100 points. If you don't pay back your student loan, it's going to be a delinquency and it's going to go down 100 points. And I think that when these things come out of deferment or forbearance, like as I did, I was like, well, I'll hide this mail and it will be okay. You know, but when your student loans actually become due, like it's a loan. Woo. And once it's active, you have to really take care of it. Now, so there's different ways that, and I think employers are doing exciting things to like help people pay off their student loan debt. Mm-hmm. What we often say is, you know, if someone needs to get it back in forbearance or you know, needs to, rehabilitate their student loan debt, we can help them because now it's gone into collections, you can bring it out. But student loan debt never falls off your credit report. It's the only thing, federal student loan debt, so you have to deal with it. And I think that's one thing, and then just realizing that as long as when you're paying back your student loan, you're building credit. So it's just kind of like getting it in context, making sure you can get a payment plan that works for you. And everybody we work with has these kind of questions.
And I think, and we'll wrap it up, we've got a minute the question actually has to be 2 roads. One, we got to get people not taking out so much student loan debt. It has to start there first, because it's now up to almost $1.4 trillion. And a lot of that is graduate loans, not just undergraduate. And so that's the first track, to try to get people to maybe go to community college first and then 4 universities, or don't live on campus and commute. Let's do that. And then the second track is to what your point is, that once you have that debt, let's learn how to manage it. And I just encourage young folks to maybe live at home or live with relatives or have 10 roommates again, because you need to get rid of that debt as soon as possible. By putting it in forbearance and putting it, shifting down the road, you increase that debt, which hurts your credit picture down the road for getting a house or getting a decent car loan. So we've got to do 2 tracks to attack that. That's a whole nother panel discussion. Diana, did you want
one small thing? Yeah, in previous research, I did studies of generations and their relationship with debt. And we're seeing increasingly that young people today are very debt averse. Yeah. And I think this also plays into these myths, right? You see people who have so much student debt that they don't want a credit card or an installment loan, but actually it's really important. So having this conversation about how debt is changing millennials and younger generations' attitudes towards holding debt is really important.
Yeah, definitely. Well, listen, you all, thank you so very much. You've been very attentive. Thank you to the panel once again. Thank you to Michelle. And I really hope that we continue this conversation. Please go to YouTube and look at this video and share it with everybody that you know. And thank you so much. We'll be around for a reception. We appreciate your attention. Yes, wait for